Hello and welcome to our Provisional Tax Masterclass. We are so thrilled to have you in this masterclass where we will be taking you through everything provisional tax. What it is, why do we pay it, when is it due, and how to make the provisional tax season seamless for you. Before we jump in, please allow me to introduce the team to you, both on the screen and behind the scenes. For those of you that don't know me, my name is Claire. I'm a professional accountant and a tax practitioner, been in the industry for 20 plus years. And we at FJM enjoy supporting businesses and taxpayers, cheerleading business success, and making sure that tax is as easy for you as taxpayers as can be. Our speaker today is the lovely Sumire van Staden. She's a professional accountant and has an absolute passion for bridging the gap between taxpayers and compliance, aka SARS, through content such as this. And we're absolutely thrilled to welcome you to our masterclass. Behind the scenes, we have Clarissa. Clarissa is a tax technician registered with SITE, and she will be taking care of any questions that you may have and technical things in the background. So I do hope that you are ready to learn all about tax. Sumire, I'm going to hand over to you.
Thank you, Claire, and good evening, everyone, and welcome back to another masterclass with the FJM team. I'm going to go ahead and switch off my camera just for purpose of bandwidth, and then let's jump right in. So I want to start us off with a quote by Albert Einstein that reads, "The hardest thing in the world to understand is income tax." And even one of the greatest minds in history struggled with the concept of income tax. But do not fear. That is why we are here tonight, to make sense of the jargon and the understanding around income tax and provisional tax to ensure that you can have control, confidence, and compliance when it comes to provisional tax and when it comes to SARS. So without further ado, let's jump into some of the content we'll cover tonight. So we've got South African tax basics, provisional tax, a little bit more about the provisional taxpayers. We're going to have a look at the dates and deadlines surrounding income tax and provisional tax. And then we're going to have a look at the hot topic or the question of the season, which is 2 years, 2 tax returns. What is going on? We're going to have a look at some top-up payments, how provisional tax is calculated, and then we'll run through income tax and provisional tax penalties, the required documents, and then some FJM top tips from our team, and then just an FAQ and poll at the end of the session. So the South African tax structure. So South Africa has a residence-based tax system, which means residents are taxed on their worldwide income, irrespective of where that income is earned. So whether a resident earns income within the borders of South Africa or perhaps earns some income from an international source, they are required to pay income tax on that amount within South Africa. For non-residents, they will be taxed in South Africa on their South African sourced income. This is known as income tax. So to understand income tax, it is the normal tax which is paid on our taxable income. And the starting point for understanding taxable income is actually to understand the definition of gross income. So if we look at the definition of gross income, it means the total amount in cash or otherwise received by or accrued to a resident of South Africa during the year of assessment, excluding any receipts and accruals of a capital nature. So if we break down this definition a little bit, the total amount just refers to something which is measurable in cash, meaning it has a monetary value, or any other consideration which we can express in terms of a monetary value. So this could, for example, be an employer providing you with a vehicle in return for perhaps a project you worked on. It's received by or accrued to. So under the Income Tax Act, we know that an amount is to be declared to SARS by the earlier date between which it was either received by or accrued to you as the taxpayer. We've spoken about the residency during the year of assessment. So year of assessment refers to the 12-month period starting on the 1st of March of a year and ending on the 28th or 29th of February of that following year. That is referred to as the year of assessment. And then it excludes any receipts and accruals of a capital nature. And just to quickly stand still here for a second, it doesn't mean that you don't declare or don't pay tax on anything of the capital nature. It just gets included in your tax return a bit differently, as there are certain inclusions and exclusions when it comes to capital gains and transactions of a capital nature. So just to take caution of that as well. And then if we look at provisional tax, I think the most important thing to take away from this session is to remember that provisional tax is not a separate tax. It's simply a prepayment of the income tax as we know it already. It is a system that allows certain taxpayers, so in other words, provisional taxpayers, to pay their income tax in advance in 2 or 3 installments during the year of assessment based on their estimated taxable income. So why do we need provisional tax, and why does it happen? So it helps the provisional taxpayer spread their tax payments over the year, so reducing that lump sum tax liability into smaller, more manageable payments. And then it also assists SARS with cash flow. At the end of the day, tax collections are SARS's greatest way of income, and it just assists SARS with a more liquid cash flow during the year. So that's why we've got provisional tax. I think the most important part is just to remember that it's definitely not a separate type of tax. And I think it's often confused to be a separate type of tax, but it's actually just a prepayment or a way to pay your tax in smaller, more manageable installments. So the provisional taxpayer. Who is a provisional taxpayer? How do we know if we're supposed to be one? What is the information surrounding that? So you're required to register as a provisional taxpayer if you earn income not subject to pay-as-you-earn. So that could be, example, if you work for an employer during the week and you've got a side hustle, maybe as a hairdresser over the weekend, and that income will then enable you to be a provisional taxpayer. You may do some freelancing work, you've got some contracting income, perhaps you have rental income, and then if you have any investment income over 30,000 Rand a year. So this could be interest, dividends, etc. SARS will generally tell you whether you meet the definition. So a way to look at that is always on your RTA 34 assessment. There's a little section where the form says whether you are a taxpayer or not. But it's important to remember that as a taxpayer, the responsibility lays with you to ensure that you do register as a provisional taxpayer from the moment you do meet the definition. So SARS have a very nice little compilation on their website as well that kind of guides you with a few questions to determine whether you do meet this definition or not. And then just to mention as well that any company, closed corporation or PTY do fall under the definition of a taxpayer, and they are also required to file a provisional tax return. So some important dates and deadlines surrounding provisional tax. SARS requires a provisional taxpayer to pay at least 2 amounts in advance during the year of assessment, which is based on an estimated taxable income. The first payment is within 6 months from the commencement of the financial or the year of assessment, and the second provisional tax payment must be on or before the last day of a taxpayer's year of assessment. So just to break this down a little bit, the first provisional tax payment is within 6 months from the start of the year of assessment, which we know is March. So this will make the first provisional tax payment due by the end of August, and the second provisional tax payment is due on the last day of the year of assessment, which is the 28th of February or the 29th, depending on whether we've got a leap year or not. And then if we have a look at a little bit of a timeline over here, this gives us a breakdown of the 2026 year of assessment. So you'll see that this 26 year of assessment starts in March 2025 and it ends on February 2026. So our first provisional tax payment is in August for the 2026 year of assessment. Our second payment for the 2026 year of assessment is in February. And then you'll notice if you look at September, I've got a little third and final payment there for the 2025 year of assessment. And we'll dig into that a bit later right now, because that does bring up quite a lot of questions and confusion when we talk about that third and final payment. And over here, we've just got a bit of a more detailed timeline of the income tax season. If you'd like to know a bit more about income tax, be sure to check out our YouTube channel. We've got an entire masterclass on there that covers everything income tax. But just to quickly run through the income tax timeline, auto assessment started being issued on the 7th of July, with tax season officially opening on the 21st of July. Provisional tax season, as we discussed, opens on the 1st of August and closes on the 31st of August. And then we've got the sneaky little 31st September top-up payment there, which we'll run through in a moment. And then we've got tax season for non-provisional taxpayers, which closes on the 20th of October. And then the final tax season that closes on the 20th of January for our provisional taxpayers. And this is definitely one of the most frequently asked questions that we get at FJM, and it is from provisional taxpayers asking us, why are they currently dealing with 2 tax years? They're dealing with 2 different returns. It just doesn't make sense. So this time of year can be very, very confusing and busy for a provisional taxpayer. And it's just because we've got 2 tax years or 2 tax periods that actually overlap, and it makes it very confusing, and it's very, very easy to mix them up. So this time of year, we always have to deal with the income tax for the prior year, so the 2025 year of assessment that ended this year on the 28th of February, and we deal with the first provisional tax payment for the following 2026 year of assessment. So that is important to note that that's kind of where the confusion comes in. It's just by the overlap of the historic year of the 2025 year of assessment and the upcoming year, which is the 2026 year of assessment. And then, like we've mentioned, this time of year we deal with the provisional tax return for the 2026-01 period. So meaning the first provisional tax payment of the 2026 year of assessment. So it runs from the 1st of March 2025 to the 28th of February 2026. And it's based on your estimated income that you've accumulated over the years so far. Even though it's just 6 months, we take that amount and we proportion it to 12 months to actually estimate your income for the 12-month period. And this return is due on or before the 31st of August 2025. And then at the same time this year, we've got the income tax return, which is your final tax return for the 2025 year of assessment. So this is the annual tax return for the period 1 March 2024 to 28 February 2025. And it includes all the actual income and expenses for that year. So if you think back when we spoke about provisional tax, we mentioned an estimated amount. This tax return is actually the actual figures that we are now submitting to SARS. And SARS used this return to determine whether our 2 provisional tax payments were efficient, whether there's a shortfall, or maybe we paid too much tax and there might actually be a refund. So if we kind of just think about these returns for a provisional taxpayer, they would actually have 3 returns during a year of assessment. They'll have their first provisional tax payment, they'll have their second provisional tax payment, and they'll have this 3rd submission called the income tax return, or commonly in practice, we refer to it as a top-up payment or a 3rd voluntary provisional tax payment. So for a return to be able to be considered by SARS as a 3rd provisional tax payment, the return must be submitted by September 2025. So even though the SARS deadline for income tax is the 19th of January, enabling us to use this as a 3rd top-up payment, we need to submit it by September. So that tells SARS that we're making a 3rd voluntary payment, and it enables us to not be affected by underestimation penalties. So just again a mention of 3 payments and why this time of year it can seem like we're paying tax on 2 different years. Okay, so some top tips from our side to make a bit more sense of this whole situation is just to always double check what tax period you are working on. If you ever receive a declaration from your account manager, the declaration will clearly state the tax year for which the information is required, either being the 2025 RT12 or income tax document or the 2026-01 provisional tax document. And like we've mentioned, the RT12 or income tax is based on actual figures, whereas the provisional tax return is more of an estimate that we've got 2 different ways that we determine, which we'll jump into shortly. So how is provisional tax calculated? So provisional tax is calculated on an estimated taxable income for the year of assessment, and this is what we call the actual method. So how this works is we take the figures that the business or the individual has accumulated for the past 6 months, and we proportion that figure to give us an estimated taxable income for 12 months. And here it's always important to just kind of note the climate of the business and the seasons that the business or individual goes through to adjust that figure accordingly. So, for example, a hairdresser might have a big influx of income during the December period when everybody's ready to go on holiday, and that should be taken into consideration when estimating the profit, just to make sure that we're working with as accurate as possible figures to help eliminate that need for the third provisional tax payment. And then we've got a second method that we use called previous, where we use the basic amount assessed by SARS in the preceding year, and we add 8% to that amount should the assessment be older than 18 months. So what is an assessment? That's the RTA 34 document which SARS issue you after you submit your final income tax return. Okay, and then provisional tax penalties. So surrounding provisional tax, we've got a few different types of penalties that SARS are able to impose, but these two are the most common ones that you might find. The first one being a late payment penalty. So this will be imposed where you've submitted your return on time and your return's actually shown a liability due to SARS, but you failed to pay that liability before the due date of 31 August. SARS will then impose a 10% on that total tax amount payable, and that's the penalty portion. They can then still add an interest portion as well, calculated at the official SARS interest rate. So just to take note that you'll have a penalty and an interest portion added to your amount should the payment be made late. And then another big one that we get is underestimation penalties. So we spoke a bit about that a bit earlier when we spoke about the third provisional tax payment. And that third provisional tax payment is there to try and eliminate the occurrence of underestimation penalties. So to prevent taxpayers from just guessing any random figure and reporting figures lower than what's actually normal for the business or what's actually estimated for the business, SARS imposed this fine to make sure that taxpayers take due care when doing provisional tax calculations. So therefore, it's very, very important to make sure that you take into consideration different seasons and different trends within your business or within your personal finances to make sure that the provisional tax payments and the taxable income is estimated as accurately as possible. Okay, and then if we have a look at some required documents, what does your account manager at FJM need to assist you with your provisional tax calculation? For companies where FJM assists with the bookkeeping, we'd need the most latest bank statements and supporting documents as requested by the account manager to assist us in bringing the trial balance and profit and loss up to date so that we have the most accurate and up-to-date figures to estimate the taxable income for the 12-month period. And where FJM do not do the bookkeeping, we would require a trial balance and a profit and loss report, as well as any supporting schedules requested by the account manager that might assist in estimating that profit. And an example for that would be like an amortization schedule on the finance lease agreement for a vehicle, which carries a bit of interest and some bank fees that kind of reduce the profit a bit and changes the estimates of the provisional tax. And then for individuals, at FJM, we send out a tax questionnaire to our clients with a bunch of different questions that the client or the taxpayer is required to complete. And that document also assists them in the supporting documents that we would need from that specific client. But that in general is just questions surrounding what was the income you've earned, how much pay as you earn have you paid, did you have a medical aid? So very similar to the questions we are used to from income tax, but just based off of a 6-month period rather than the actual 12-month period. And then to jump into some top tips from our team here at FJM, from Cindy, we've got a top tip to utilize the opportunity to make that third top-up payment. It prevents unwanted penalties and interest. From Ashley, we've got, even if you owe no tax, but you are a provisional taxpayer, you are still required to submit a provisional tax return. And then this is just more commonly known as a nil return. So even if you've got a loss, it's still important to submit that return to remain compliant. And then from Amanda, we've got to keep your tax documents in order and up to date at least every 2 months, especially if you're an individual and you've got your own little business. etc. It's very important to keep up to date with those documents and looking at them ever so often to make sure everything is in order, that when we get to this busy season in the year, that we don't have to panic about documents and compiling trial balances, etc. We can just send through the figures and calculate the provisional tax from there. And then finally, just to run through a bit of a FAQ, these are some common questions that we receive in practice. So how do I register or deregister as a provisional taxpayer? So on e-filing, there's a little section called tax types, and under tax types, you would be able to either activate or deactivate the provisional tax type. Just important to mention that if you are required to submit provisional tax and you actually deactivate it, there's a very big chance that SARS will automatically reactivate it once you've submitted your income tax return, as it will trigger the system to tell SARS that you are a provisional taxpayer. So just always make sure that you check on your RTA 34 assessment whether you are a provisional taxpayer or not. And then, am I still a provisional taxpayer if I earn a salary as well as a freelance income? So as we mentioned before, the moment you've got an income of which pay as you earn is not deducted, that triggers the provisional taxpayer status. So in this case, although the person has a salary, which most likely has pay as you earn deducted from it, they have a freelance income as well that would require them to be registered as a provisional taxpayer. And then my business is running at a loss. Do I need to submit a provisional tax return? And I think we've mentioned from Ashley's top tip that yes, you most definitely still need to submit a provisional tax return. Even if your business is running at a loss, it would just be a nil return. And then I missed the deadline. What now? The most important thing if you've missed the deadline is to submit your return as soon as possible and pay any amount that is due. There are some certain instances where you can dispute late submission penalties with SARS, but they are rather strict when it comes to that. So it's very important to always make sure that you submit your returns on time. And then if my employer is taking off pay as you earn each month, do I still pay tax again? No, you do not. So your pay as you earn is deducted from your taxable income that we calculate when we do the provisional tax return. So again, provisional tax is not an extra tax. It's just a prepayment of tax. And pay as you earn actually works in a similar way. It's a prepayment of tax. So it gets deducted. It's not an additional tax that you are required to pay. And then do I include all my income when completing my provisional tax return? And yes, you must definitely include all your income, just like you would on your normal income tax return. You include all your income on your provisional tax return as well. So that's all from me on our provisional tax webinar. We're going to have a bit of a quick poll down in the comment section and in the chat section. So please feel free to head over there and complete the poll. And then finally, if there's any questions, please feel free to leave them in our chat box or down in the comment section, and one of our account managers will get back to you as soon as possible with the answer to your questions.
Thank you for watching our tax masterclass. We hope you've walked away with practical insights and a clearer understanding of how to make this tax season your easiest one yet. If you have found this video helpful, don't forget to like, subscribe, and share it with others who might benefit. As Therese mentioned, if you have any questions, please feel free to drop a comment below or reach out to our team. We are here to help. And if you need any more support, we at FJM do offer professional consultations to help you file smarter and maximize your deductions. You'll find a booking link in the description below. As a bonus, we've put together some free downloadable checklists, templates, and a handy tax guide to help you step by step through your filing. And this can be found on our website, which is also linked below. Use it, share it, and make tax time a breeze. Until next time, stay informed, stay organized, and let's make taxes work for you.